Hello, digital currency enthusiasts and the crypto curious. Strap in as we delve into the complex universe of cryptocurrency and its global regulation. Today we're going on a whirlwind tour exploring how countries around the globe are navigating the crypto revolution. We'll also touch on the crucial roles of KYC and AML in the world of crypto exchanges. Intriguing, isn't it? So buckle up for this enlightening journey through the digital currencies landscape. Let's get started, shall we? Starting with the United States, where the crypto regulatory landscape is complex. The land of the free and home of the brave takes a multifaceted approach when it comes to cryptocurrencies. Different US agencies have their own interpretations. They classify cryptocurrencies as property, commodities, or securities. It's like trying to fit a square peg into a round hole. It's a bit of a puzzle. But why does this matter? Well, each classification comes with its own set of rules and regulations. For instance, the Commodity Futures Trading Commission views cryptocurrencies as commodities, which means they fall under certain derivative contract regulations. Meanwhile, the Securities and Exchange Commission often treats initial coin offerings, or ICOs, as securities, subjecting them to a whole different set of laws. And then there's the Internal Revenue Service, the tax guys. They treat cryptocurrencies like property, meaning you could be liable for capital gains tax when you sell or use your crypto. The IRS, for instance, treats them as property for tax purposes. Crossing over to Europe, the approach to cryptocurrency regulation is somewhat unified, but still varied. The European Union, as a collective body, is making strides towards creating a standardized regulatory framework for cryptocurrencies. The aim is to ensure a level playing field across member states and to protect consumers and investors from potential risks associated with digital currencies. However, even within the EU, there's a complex tapestry of unique national regulations. For instance, Germany has taken a progressive stance, recognizing Bitcoin as a private money and allowing banks to sell and store cryptocurrencies. On the other hand, France has implemented stringent rules to combat the potential misuse of digital currencies, requiring crypto exchanges to register with the French Financial Markets Authority. These variations reflect the balancing act between embracing innovation and ensuring consumer protection in the ever-evolving crypto landscape. Individual countries like Germany and France have their own unique rules, offering a rich case study for the global crypto community. In Asia, countries like Japan have embraced cryptocurrencies, recognizing Bitcoin as legal tender. Japan is a pioneer in this space, having passed a law in 2017 that allows crypto trading in a regulated environment. The country has a clear regulatory framework in place, making it a safe and secure environment for both crypto enthusiasts and investors. But let's contrast this with another Asian giant, China. China's stance on cryptocurrencies is markedly different. The Chinese government views cryptocurrencies as a threat to its financial stability and has taken a more restrictive approach. The country has banned all cryptocurrency exchanges and initial coin offerings, also known as ICOs, and has even clamped down on mining operations. These contrasting approaches reflect Asia's diverse regulatory landscape. On one end of the spectrum, Japan is leading the way with progressive regulations, while on the other end, China remains resistant to the crypto wave. China has taken a more restrictive approach, banning crypto exchanges and ICOs. It's a mixed bag globally, with some nations like El Salvador adopting Bitcoin as legal tender. Indeed, the global perspectives on cryptocurrency regulation are as varied as the countries themselves. Each nation's stance is influenced by its unique economic, political, and social contexts, leading to a fascinating array of approaches. In the Americas, countries like Canada are developing robust crypto regulatory frameworks, while Latin American countries like Argentina and Venezuela are seeing a surge in crypto use due to economic instability. On the other hand, in Africa, nations like Nigeria are grappling with how to regulate cryptocurrencies amidst high adoption rates and concerns over financial security. Down under in Australia, the government is fostering a crypto-friendly environment, promoting innovation while ensuring consumer protection. Meanwhile, in the Middle East, countries like the United Arab Emirates are positioning themselves as crypto hubs, adopting progressive regulations. However, it's not all smooth sailing. In many parts of the world, regulatory uncertainty looms large. Countries are grappling with how to balance the promise of decentralized finance with the potential risks. These include issues around consumer protection, financial stability, and the potential for misuse in illegal activities. In essence, the global regulation of cryptocurrencies is a complex, dynamic landscape, with each country charting its unique path. As we continue to navigate these uncharted waters, one thing is clear. The conversation around crypto regulation is far from over. This patchwork of regulations reflects the diverse perspectives on the potential and risks of digital currencies. Now, let's talk about KYC and AML, critical acronyms in the crypto exchange world. KYC, or Know Your Customer, is a process that involves verifying the identity of the users. Think of it as a virtual ID check that makes sure exchanges know who their customers are. On the other side of the coin, we have AML, which stands for anti-money laundering. This involves rules and regulations designed to prevent the laundering of the money through crypto transactions. Exchanges are vigilant about monitoring for any suspicious activities and dutifully report them to the relevant authorities. It's akin to having a digital watchdog keeping a close eye on potential financial crimes. These mechanisms are not just fancy acronyms, they're the backbone of secure and responsible crypto exchanges. They help prevent fraudulent activities and play a crucial role in user security. This process helps prevent the fraudulent activities and is essential for user security. AML, on the other hand, involves procedures and regulations to prevent money laundering through crypto transactions. At its core, anti-money laundering is like having a digital watchdog for financial crimes in the crypto world. It scrutinizes transactions, examines patterns, and raises the alarm when something seems off. Banks and other traditional financial institutions have long been required to have AML procedures in place, and now these rules are being applied to the world of cryptocurrency. Crypto exchanges are required to monitor for suspicious activities, such as unusually large transactions, frequent rapid trades, or transactions structured to avoid reporting requirements. When these red flags are detected, exchanges are obligated to report them to the relevant authorities. This way, potential money laundering can be identified, investigated, and hopefully prevented. But why is this so important? Well, cryptocurrencies, with their digital nature and sometimes anonymous transactions, can be appealing for illicit activities. AML rules help to deter and detect these activities, making the crypto world a safer place for everyone. These measures are crucial for legitimizing the use of cryptocurrencies and ensuring they're not misused for illegal activities. Sure, they can be viewed as burdensome, and some may argue they infringe on privacy, but without them, the risk of financial crime soars, and the reputation of cryptocurrencies could be seriously damaged. The bottom line is, AML plays a pivotal role in maintaining the integrity of the crypto world and fostering its responsible growth. In conclusion, the world of cryptocurrency is as diverse in its regulation as it is in its application. We've journeyed through varying global perspectives and understood the indispensable role of KYC and AML in crypto exchanges. As the landscape continually evolves, these regulatory frameworks guide our path in this digital financial revolution. Knowledge of these systems is crucial for both traders and enthusiasts. That's it for today's exploration into cryptocurrency and regulation. Stay informed, stay secure, and keep navigating the exciting world of digital currencies.